CFA Level 1 Practice Questions. Learning Module, Capital Structure. Topic, the cost of capital. A firm has a target capital structure of 40% debt and 60% equity. The before-tax cost of debt is 5% and the cost of equity is 11%. If the corporate tax rate is 25%, the firm's weighted average cost of capital, WACC, is closest to A 7.5%, B 8.1%, C 9.0%. A company's chief financial officer, CFO, states that the firm can lower its overall cost of capital by directly setting a lower required return for its new bond issuance. This statement is most likely A, correct, because management has full control over its financing costs. B, correct, because the cost of debt is based on the company's existing financial statements. C, incorrect, because the required return is determined by investors in the financial markets. When calculating a firm's weighted average cost of capital, WACC, using the market values of debt and equity instead of their book values will most likely result in A different WACC because market values reflect investors' current opportunity costs. B, lower weight for equity if the firm's market capitalization has decreased. C, more stable WACC over time because market values are less volatile than book values. A firm has a market value of debt of $150 million and a market value of equity of $350 million. The before-tax cost of debt is 6%, the cost of equity is 11%, and the corporate tax rate is 25%. The firm's weighted average cost of capital, WACC, is closest to A 8.5%, B 9.0%, C 9.5%. The primary goal of managing a company's capital structure is to A, minimize the weighted average cost of capital, WACC. B, minimize the use of debt to avoid financial distress. C, maximize the proportion of equity financing. An analyst is calculating the WACC for an all-equity firm. Which of the following is the most appropriate method to estimate its cost of capital? A, use the firm's cost of equity, as it is the only component. B, use the yield to maturity on the firm's long-term bonds. C, use the average historical return on the firm's equity. Unlevered firm has a cost of equity of 9% and a market value of $80 million. It issues $20 million in debt at a cost of 5% to repurchase equity. Ignoring financial distress costs and assuming a corporate tax rate of 25%, the firm's WACC after the recapitalization is most likely A, lower than 9%, B, equal to 9%, C, higher than 9%. A firm's capital structure consists of 40% debt, 10% preferred stock, and 50% common equity. The respective costs are 8% for debt, 12% for preferred stock, and 15% for common equity. If the corporate tax rate is 30%, the firm's WACC is closest to A, 10.9%, B, 11.2%, C, 12.8%. A firm has a WACC of 8.4%, a before-tax cost of debt of 5%, a cost of equity of 10%, and a tax rate of 30%. If the weight of equity and debt in the capital structure are unknown, the weight of equity is closest to A, 25%, B, 60%, C, 75%. A firm's capital structure is 40% debt, 10% preferred stock, and 50% common equity. The cost of debt is 7% before tax, the cost of preferred stock is 9%, and the cost of common equity is 12%. If the corporate tax rate is 30%, the firm's WACC is closest to A, 8.6%, B, 8.9%, C, 9.7%. The primary reason the after-tax cost of debt is lower than the before-tax cost is that A, equity investors require a lower return than debt investors. B, debt payments are fixed obligations that must be paid before dividends. C. Interest expense is tax deductible, reducing the government's claim on earnings. All else being equal, if a company's marginal tax rate increases, what is the most likely impact on its weighted average cost of capital? WACC? A. WACC increases. B. WACC decreases. C. WACC remains unchanged. Always adjust debt for taxes, apply the correct capital structure weights, and recognize equity's higher required return. Required return, cost of debt, is determined by investors and financial markets, not by management. Market participants set yields based on risk, creditworthiness, and economic conditions. Reinforces that management cannot control financing costs. Financial statements inform investors, but external market factors, interest rates, sentiment, credit ratings, ultimately drive the required return. Market values reflect investors' current opportunity costs. They capture real-time risk and return expectations, making WACC more relevant for decision-making than book values, which are historical. Equity weight changes, B, are situational, not the general reason for using market values. Market values are more volatile, not more stable, C, so they don't make WACC steadier. Total value of the firm, $500 million. Market value of debt, $150 million. Market value of equity, $350 million. Weight of debt, 30% of the total capital. Weight of equity, 70% of the total capital. Weighted average cost of capital, WACC, 9.05%. Primary goal of capital structure management is to minimize WACC. Lower WACC reduces the cost of raising capital, increases firm value, and balances tax benefits of debt with financial distress risks. Avoiding debt entirely, B, ignores the tax advantages debt provides and can lead to higher WACC. Maximizing equity, C, raises WACC since equity is more expensive than debt. For an all-equity firm, WACC equals the cost of equity only, since there is no debt, no tax shield, and no debt weighting. Models like CFA or DDM are used to estimate this forward-looking required return. Yield to maturity, B, is irrelevant because the firm has no debt. Historical returns, C, are backward-looking and don't reflect current investor expectations or risk. Cost of equity must be forward-looking. Issuing debt creates a tax shield, which increases firm value and changes the weights of debt and equity. This sets up why WACC can fall below the unlevered cost of equity. While the cost of equity rises with leverage due to higher risk, the after-tax cost of debt is lower, and when combined with the new weights, the overall WACC drops to 8.47%. Confirms with a simplified M with taxes formula that WACC decreases because of the debt tax shield, even though equity becomes riskier. Structure weights, debt, 40%, preferred stock, 10%, common equity, 50%. Cost of capital, debt, 8%, preferred stock, 12%, common equity, 15%. Corporate tax rate, 30%. Adjust debt for taxes, 8% times 1 minus 30% equals 5.6%. Multiply each component by its weight, debt 2.24%, preferred 1.2%, equity 7.5%. Sum the weighted costs to get WACC equals 10.94%, closest to 10.9%. WACC equals 8.4%. Before tax cost of debt equals 5%, After tax equals 3.5%. Cost of equity equals 10%. Debt and equity weights unknown but must sum to 1. Set up WACC formula with unknown equity weight. Solve for equity weight. 0.084 equals 1 minus WE times 0.035 plus WE times 0.10. Result, equity weight 75%. Capital structure. 40% debt, 10% preferred stock, 50% common equity. Corporate tax rate, 30%. Cost of capital, after-tax cost of debt, 4.9%, cost of preferred stock, 9%, and cost of common equity, 12%. Adjust debt for taxes, 7% times 1 minus 30% equals 4.9%. Multiply each component by its weight. Debt 1.96%, preferred 0.9%, equity 6%. Sum the weighted costs. 8.86%, which is closest to 8.9%. After-tax cost of debt is lower because interest expense is tax-deductible. This deduction reduces taxable income, lowering the government's claim on earnings and making debt financing cheaper after taxes. Equity investors requiring higher returns explains equity's cost, not the tax effect on debt. Debt's priority over dividends, B, describes payment hierarchy, but does not explain the tax shield benefit. A higher marginal tax rate increases the tax shield on debt, lowering the after-tax cost of debt. Since debt is cheaper than equity, this reduces the overall WACC. WACC does not increase A because the tax shield makes debt cheaper, not more expensive. WACC does not remain unchanged, C, because the tax rate directly affects the after-tax cost of debt, a key input in WACC. Topic: Factors affecting capital structure. As a company progresses from the growth phase to the mature phase, its ability to use unsecured debt financing will most likely decrease due to higher business risk. B, remain unchanged as the debt type is fixed by industry. C, increase as its cash flows become more stable. All else being equal, a company with a high proportion of fixed costs to total costs, high operating leverage, will most likely have M, a lower cost of equity due to more stable profit margins. B, a higher cost of debt due to greater volatility in operating income. C, a lower weighted average cost of capital, WACC, due to economies of scale. A manufacturing company has recently entered its growth phase, with revenues accelerating but operating cash flow still negative due to significant capital expenditures for new production facilities. The company's assets are primarily specialized machinery. If it seeks external debt financing, the most likely form it will obtain is A, unsecured bonds with a low coupon rate. B, convertible debt from venture capital investors. C, secured debt using the machinery as collateral. A company characterized by low asset turnover, high capital expenditures to sales, and high net working capital to sales ratios is best described as having A capital-light business model. B, capital-intensive business model. C, business model based on contractual relationships. A company in the growth phase of its life cycle is most characterized by A, minimal revenue and high business failure risk. B, rising revenues but likely negative free cash flow due to investment needs. C, stable, predictable revenues and positive free cash flow. Which of the following corporate actions is most consistent with the pecking order theory? A, an automobile manufacturer uses its retained earnings to build a new factory. B, a highly profitable tech company with no debt issues new shares to fund an acquisition. C, a startup firm with volatile earnings chooses to finance a new project with a public equity offering before seeking a bank loan. As a company matures, cash flows become more stable and predictable, reducing business risk. This stability improves creditworthiness, allowing the firm to access unsecured debt financing more easily. Business risk does not increase in maturity. Option A, it declines. Debt type is not fixed by industry. B, it evolves with the firm's life cycle and financial health. High operating leverage increases earnings volatility because fixed costs magnify changes in sales. This greater volatility raises perceived default risk, so lenders demand a higher return, increasing the cost of debt. A, equity cost does not decrease, it rises with risk. Economies of scale, C, improve efficiency, but do not offset the financial risk from high fixed costs. In the growth phase, the company has rising revenues but negative cash flow due to heavy capital expenditures. Since it owns tangible assets, specialized machinery, lenders are most likely to provide secured debt, using those assets as collateral. A, unsecured bonds require strong creditworthiness and stable cash flows, which the firm does not have. Convertible debt, B, is more typical for early-stage startups without tangible assets, not for asset-heavy manufacturing firms in the growth phase. Low asset turnover, high capex to sales, and high working capital to sales all signal heavy reliance on physical assets. This defines a capital-intensive business model, common in industries like manufacturing or utilities. A, capital-light firms show the opposite traits: high turnover, low capex, minimal working capital. Contractual models, C, rely on agreements for revenue, not asset-heavy operations, so they don't match the ratios described. In the growth phase, revenues are rising, but free cash flow is often negative because heavy reinvestment in expansion, R&D, and capital expenditures exceeds operating inflows. Companies rely on external financing to sustain growth. A, minimal revenue and high failure risk describe the startup stage, not growth. Stable revenues and positive free cash flow, C, describe the mature stage, not growth. Pecking order theory prioritizes internal funds first, then debt, and lastly equity. Using retained earnings for investment, option A, perfectly matches this hierarchy. Issuing equity, B, violates the theory since equity is the most expensive and sends negative signals. Choosing equity before debt, C, also breaks the hierarchy, especially harmful for startups with volatile earnings. Adds that equity issuance is generally costlier and riskier than debt. So even for startups, debt should be preferred over equity when external financing is needed. Topic: Modigliani-Miller Capital Structure Propositions. According to Modigliani and Miller's Proposition II without taxes, as a firm increases its debt-to-equity ratio, what is the most likely impact on its cost of capital components? The cost of debt remains constant and the cost of equity decreases. B, the cost of equity increases, perfectly offsetting the use of cheaper debt, leaving WACC unchanged. C, the weighted average cost of capital, WACC, decreases because of the greater proportion of lower-cost debt. The central insight of Modigliani and Miller's work on capital structure is that capital structure is the most important decision for maximizing firm value. B, firm value is primarily driven by investment decisions and their resulting cash flows, not financing. C, managers should always use as much debt as possible to maximize the tax shield. In the Modigliani-Miller world without taxes, if a firm issues new debt and uses the proceeds to repurchase equity, the most likely immediate impact is A, an increase in the cost of equity and no change in firm value. B, a decrease in the firm's WACC. C, an increase in the cost of debt on a decrease in firm value. The difference in the cost of equity calculation between Proposition II with taxes and without taxes is accounted for by A. Including the tax shield on debt in the risk-free rate. B. Multiplying the risk premium component by 1 minus tax rate. C. Subtracting the corporate tax rate from the debt-to-equity ratio. A firm with an unlevered value of $80 million issues $20 million of perpetual debt. If the corporate tax rate is 25%, the increase in the firm's value due to the debt issuance is closest to A. $5 million. B. $15 million. C. $20 million. Under Modigliani and Miller's assumptions without taxes, if a firm issues debt and uses the proceeds to repurchase equity, the overall effect on the firm's WACC is A. A decrease. B. An increase. C. No change. As leverage debt-to-equity ratio increases, the cost of equity rises to compensate for higher financial risk. This increase exactly offsets the benefit of cheaper debt, leaving WACC unchanged. A. Cost of equity does not decrease. It increases with leverage. WACC does not fall. C. Under without taxes, capital structure has no effect on WACC. Firm value depends on investment decisions and resulting cash flows, not financing choices. In perfect markets, capital structure is irrelevant because investors can replicate leverage themselves. A. Capital structure is not the most important driver of value. Investment projects are. Maximizing debt for tax shield. C. is only relevant under with taxes, but not the central insight of the original theory. Issuing debt and repurchasing equity increases leverage, which raises the cost of equity due to higher risk. However, WACC and firm value remain unchanged in a no-tax world because financing decisions do not affect overall value. WACC does not decrease. B. Under without taxes, WACC is constant regardless of capital structure. Cost of debt does not rise and firm value does not fall. C. In perfect markets, debt risk is unaffected and capital structure irrelevance holds. The difference comes from the tax shield adjustment. With taxes, the cost of equity formula multiplies the risk premium component, R0 minus RD, by 1 minus T, reducing the impact of leverage on equity cost compared to the no-tax case. A. The tax shield does not affect the risk-free rate. The tax rate does not change the debt-to-equity ratio. C. It only scales the risk premium. The increase in firm value comes only from the tax shield on debt, calculated as debt times tax rate. With $20 million debt and a 25% tax rate, the tax shield is $5 million, which raises firm value. $15 million. B is impossible because the tax shield cannot exceed debt times tax rate. $20 million. C is incorrect because debt itself does not add to firm value. Only the tax savings do. Under Proposition I, no taxes, WACC is unaffected by capital structure. Issuing debt and repurchasing equity raises the cost of equity due to higher risk, but this is exactly offset by the cheaper cost of debt, leaving WACC unchanged. A. WACC does not decrease because there is no tax shield in the no-tax case. WACC does not increase. B. Because the rise in equity cost is balanced by debt's lower cost. Topic: Optimal capital structure. A key implication of the pecking order theory is that a firm's capital structure tends toward a target debt-to-equity ratio that minimizes WACC. B is primarily determined by its cumulative need for external funds over time. C reflects a balance between the tax benefits of debt and costs of financial distress. If a company's target weight of debt in its capital structure is 40%, the corresponding target debt to equity ratio is closest to A 0.40, B 1.50, C 0.67. The idea that a firm has a specific optimal debt to equity ratio that balances the value of the interest tax shield against the costs of financial distress is a key feature of the pecking order theory, B static trade-off theory, C free cash flow hypothesis. A firm can reduce its expected costs of financial distress by A. Increasing its proportion of fixed costs to total costs, B. Investing in specialized equipment with no alternative use, C. Maintaining a high level of liquidity and marketable securities. When calculating WACC, a firm's target capital structure is most often based on A. Current market values of debt and equity, B. The book values of debt and equity, C. The average market values of its competitors' debt and equity. A firm with an unlevered value of $100 million issues $40 million in debt. If the corporate tax rate is 20% and the present value of financial distress costs is $3 million, the value of the levered firm is closest to $105 million, B. $108 million, C. $117 million. According to the static trade-off theory, a firm's optimal capital structure is reached when A. The present value of financial distress costs is 0. B. The marginal tax shield benefit of debt equals the marginal cost of financial distress. C. The firm is entirely financed by equity to avoid any risk of distress. Under the pecking order theory, capital structure is not about targeting an optimal debt-to-equity ratio. Instead, it evolves based on the firm's cumulative need for external funds. Firms use internal funds first, then debt and equity only as a last resort. A. A target debt-to-equity ratio reflects the static trade-off theory, not pecking order. Balancing tax benefits of debt against distress costs, C, is also part of the trade-off theory, not pecking order. A 40% debt weight means debt is 40% of total capital, while equity is 60%. The debt-to-equity ratio is calculated as debt divided by equity, so 0.40 divided by 0.60 equals 0.67. A. 0.40 confuses debt weight with debt-to-equity ratio. The ratio compares debt to equity, not total capital. 1.50, B, is the inverse, equity to debt, and would only apply if debt were 60% and equity 40%, which is not the case here. The static trade-off theory defines an optimal debt-to-equity ratio by balancing the tax benefits of debt against the costs of financial distress. This balance maximizes firm value. A. Pecking order theory focuses on financing hierarchy, internal funds, debt, equity, not targeting an optimal ratio. Free cash flow hypothesis, C, addresses managerial discipline through debt, but does not involve balancing tax shields and distress costs. Adds that while the free cash flow hypothesis supports higher debt as a control mechanism, it is not about finding an optimal debt-to-equity ratio. Maintaining high liquidity and marketable securities provides a buffer, allowing the firm to meet obligations, avoid forced asset sales, and reduce both the likelihood and severity of financial distress. A. Increasing fixed costs raises operating leverage and risk, making distress more likely. Specialized equipment with no alternative use, B, reduces flexibility and has low liquidation value, worsening distress. Adds that investing in such specialized assets actually increases distress costs since they cannot be easily repurposed or sold. Firms usually base their target capital structure on book values, since they are stable, less volatile, and widely used by lenders and rating agencies for long-term planning and covenants. A. Market values are appropriate for calculating current WACC but too volatile for setting long-term targets. Competitor averages, C, can serve as benchmarks, but do not determine a firm's own target structure, which depends on its unique risk profile and strategy. Issuing debt adds value only through the tax shield, debt times tax rate. Here, $40 million times 20% equals $8 million. Subtracting the $3 million distress costs gives a net gain of $5 million. Reinforces that the levered firm's value equals unlevered value plus net leverage effect. So $100 million plus $5 million equals $105 million. This reflects the trade-off theory, balancing tax benefits against distress costs. The optimal capital structure occurs when the marginal tax shield benefit of debt equals the marginal cost of financial distress. This balance maximizes firm value. A. Distress costs do not need to be zero. The goal is balancing benefits and costs, not eliminating them. Equity financing, C, avoids distress but sacrifices tax shield benefits, making it suboptimal.